Welcome to readtheticker.com. Today we're going to talk about determining whether a pattern is a continuation or a reversal. Here we have a couple of generic patterns. A pattern that starts with a downswing and you get a consolidation. There is a debate whether it swings up or swings down. Is it a continuation down, or is it could be a reversal up? Is it going to be accumulation or redistribution? We have patterns with an upswing tail. You get some waves in the middle. All these lines are waves, the black lines, and we wonder whether it's going to be a continuation or a reversal. Now we must take into account the overall trend, but in some instances there is rotation, and sometimes we do get a downswing that is followed by continuation and up when the major market's up, i.e. energy recently. So we have to take into account that, but let's have a look. The short answer is examine the waves within the pattern. How much volume per wave? Low, high, average or extreme? Is it an up wave or a down wave? Is the volume less or more than the previous waves? Is the wave making a new high or low? Use the above to evaluate the Wyckoff law, effort versus results. Now, here, analogy to make the explanation a bit more clearer. Consider yourself a professional boxing judge. Your role, ringside, during the fight, is to grade each punch. That's the effort one boxer has in doing damage to the other. He launches his arm, he fires a hard punch that is draining his energy, and the effect of the damage it has on the result. So if you've got a man punching another and he tries really hard, but the damage effect he has on the other must be measured. Imagine a 6-year-old trying to punch a fully grown man. It would just have no effect. So you want to gauge the damage, the effort one fighter has, or one wave has, on its opponent. Normally, what normally happens if a fighter is making regular contacts with the other and there's no damage done, it's unlikely that that fighter will win. If the opposing fighter hits the other fighter less but does way more damage, then he's likely to win. It's the effort versus results which measures the response. This is the same in a stock price. You must measure the supply waves and the demand waves of a stock price and take note which price waves are doing the damage to the trend, support or resistance. And you might get price action waves which are lots of effort but they're doing no damage. Then again you might get price waves which have very little effort, i.e. volume, and they're doing a lot of damage. So you have to take into account where the demand and supply is coming and the effect the demand and supply is having. For example, in an upswing you might get a very high volume down wave, but it's doing no damage. That suggests that the supply coming to the market is being purchased, therefore the demand is higher than supply. Same with a demand wave. You may get a strong wave up with massive volume, but the damage to the price action is minimal or not as much as it should be for that volume. Thus you can suspect some suppliers coming into the market. Right, let's have a look at Amazon. Now Amazon, I'll just scroll up, recently had this is a high level chart, a weekly chart, had a continuation pattern, or now it's known to be a continuation pattern. But I'll show you the secrets, how you could have forecasted this. This is a daily chart, and as you see, you'll see colours here, red and green. The red is downswing waves, and the green is upswing waves. And we have a standard volume chart here. Red is down, blue is up, and the band is the average. So you can see some extreme, you can see some low, you can see some average volume. Now this volume wave down below is an accumulation of the colour of the volume during the colour of this wave. So this green swing up is the accumulation of volume in that wave up there, and the red is the accumulation of the volume on the wave down. So this volume wave bar is an accumulation of the daily volume up here. Alright, so another thing to note is that, I'll just scroll down here, the calculation of these waves and the calculation of the volume wave down by bar is exactly the same. That's why I take the same time frame. So this is a wave presentation. This is a wave presentation. If I scroll down below to the daily point and figure chart, just quickly scroll down. Where are we? Oh, here we are. Here's a point and figure chart, and the volume below. This is the sum volume. This is a point and figure. The wave calculation here on this point and figure chart, and the volume determination here is exactly as I have stated above in the daily chart. So, in summary, the calculation for waves and price is shown with the painted bars, and volume is exactly the same calculation for determining the wave structure point and figure chart. It is a centralized function that is shared by many presentations, as you're seeing here. So the same calculation is just used many different times in different presentations. So what do we have here? Okay, it's a daily chart here, and we saw this big explosion here. So what actually happened? We had a strong wave up here. We had lots of volume. If you note, I'm talking about this wave here. And if you note, on the second wave down, we had a wave down that did not make any more break support, but it was much more volume. So therefore that was a poor punch, we would say, but lots of volume, so there was demand coming in. Then we had a counter punch, no real effort there to drag it up. Another wave, we had the two bearish waves in a row. This one here and that one there showed much larger volume than the previous wave. So here we had the previous wave, much larger volume, but it made no in-grounds into support. Support held. That means demand was taking up all the supply on offer. So in a sense, it was a bit of smoke and mirrors by the market to show that yes, it's going down, but the composite man was buying, ready for a launch up, and I think here was an earnings day of some sort. So this whole pattern here, from here to there, it was a preparation on the assumption that it was going to go higher. So this was pretty much an attack by the composite man. They accumulated much stock float, and now they're reaping the profits up here. And as you can see, they've accumulated here, and they're ready for a reaccumulation up here. So big volume wave up here, and small little volume waves here. And as you can see, this is just a continuation, but this is a base here. Now this actually started. This pattern here actually was primed back here. We saw the down wave here, bit of mucking around, no form, some big volume coming, two big up volume waves. It's actually going up too quickly. See, two big volume waves beating this one here, smash back down, and here we had a situation where the market realised we need more time to accumulate, so they pushed it up to sell into. So here we had all that volume coming up, but it made no new high, and it came down so they could buy more, but generally that wave up there was for preparation to push down. Support held. Support held with all this volume action going on. So this market was always going to be a continuation. Those who were shorting it, seeing these swings down, were greatly mistaken, because all that volume and all that effort was not getting the results to go through support. So if I scroll down to the daily bar chart, point and figure chart, we see that action in here. Here we had the blue bar starting to win, higher blue bars. We had a red bar that we thought should win, but didn't take out any new lows, so that was negated. That was negated as a supply controlling wave. We'd have had to score that for the demand, because all that volume, it didn't take out new lows. Had another attempt here with more volume, so that red bar is more volume than that, but less than that. Still didn't take out new lows. And then, the composite man showed its hand here and pumped the market up, and as you can see, the blue bars are beating the red bars. Classic Wyckoff logic to determine that. Now, I'm going to have a look. That was a base continuation pattern with, as we know, the overall trend is up. Let's have a look at one that went the other way. XLE suffered a slump recently on the crashing oil price. Obviously, the fundamentals were bad, but no one really assumed whether the price would go as low as it would. So let's have. Okay, we have a downswing here, and we have a continuation pattern here that went down here. But we want to look in there before this actually happened to see if there's any clues. Because we've got a continuation pattern down and we've got a base pattern which is actually forming to go up. We'll scroll down to our daily chart. Here we have, oops, it was set up. Yeah. Here we go, it's better, isn't it? Had a tail downswing here, the big volume, and we had just an automatic reaction here. Obviously shorts covering, but no real volume pushing it higher. You see that there's no real volume to challenge that. And then some selling came in again, and it pushed it back down there. So if I scroll down to the point and figure chart, where are we? Here we go. As you can see there, big powerful punch down, and there was no real power in the blue bars bouncing, and then slowly the selling came back in and pushed it down again. But as you should see down below here, you'll see some of the blue bars being more dominant. Here we have blue bar, that really didn't take out, we had a strong sell down here, we had a blue bar here, but it really didn't change things. Here we have a blue bar that starts the win, and another blue bar that starts the win, takes out the high, and this one here, you can see that red bar strong down, but it didn't make any new low. So as you can see there, the red bar is starting to lose, and the blue bar is starting to win. And if you know the latest bars, it actually took off, it's starting to take off now. So I'll be watching energy stocks quite closely. If I go back up to the daily chart, where are we? Just scrolling through my swing pop-out chart that I formatted for myself, which just allows me to review the story of what's going on here. So once again, as I said before here, no real punch-up, no winning going on by demand. A continuation short here. We have a, this actually ended up being a bit climactic, these 2 points here. Automatic move, secondary test, and all. Obviously this is getting a bit more detailed, understanding the continuation pattern. But we are examining the waves. And as you can see here, this wave started to be, this red volume wave started to be a bit more powerful here. And this green, this first is the first sign of some real demand coming in here. Right, see, strong green upswing. And what's more, this is the confirmation of the demand. I'll just draw those things there. Strong up wave, lots of volume. Slightly just took out resistance. But here's a telltale sign. You have a swing down, pretty much equal volume, but no new support not taken out. Pretty much hold. So that between this time frame and that time frame is demand showing its hand, and the tightness in the bars show that they're actually accumulating price in a strong form. So a very, very positive entry could have been made about here. And at the moment, it's still holding true. So I would, it's taking on, at the moment, the price is taking on resistance. If you look at the daily current situation, it still looks pretty positive for the energy stocks. All the volume down here says climactic, weak hands going over strong hands. As the selling, see how the volume is falling? That's the selling and the supply being soaked up, and see how the volume's fallen straight down here. That basically meaning all the short, and all the weak hands have probably been flushed out. We're getting a bit right down here. Sorry, excuse me. If you notice here, it's a good sign after a period of selling like this, when the volume dries up and goes dull. That means the buyers know, well, there's no one coming to the market with more selling. Those who have accumulated go, right, there's no sellers out there, I can have a go at punching the prices up. Obviously, if you're understanding the point and figure waves, and you get to examine it via the volume wave, the price volume wave, and also the point and figure chart volume wave, we have our scanner here to help you follow the waves either in a selected range of stocks. We have our selected range of stocks like Dow Industrials or sectors, or a user generated list of stocks. So if you create a work group and you put a bunch of stocks in there, you can select your type. There, you just select that like that. And it punches your stocks in the selection here, so you can examine your watch list or your portfolio and see how the waves are performing within your selected charts. One last comment, readtheticker.com is a representation of the works from Richard Wyckoff and those who have done the best to interpret his work as accurately as possible. If you're a member of RTT Plus, you have access to the RTTWC blog, and you'll see the method for our madness described in RTTWC workbook and RTTWC Wyckoff. And this workbook here, which is a high-level summary, I think it's the first page, The Art of Wyckoff Analysis by Stuart Taylor. Taylor says, the art of price and volume. He makes a quick little summary. Wyckoff is the study of price and volume and the relationships between individual waves of buying and selling. That first line says it all. These relationships reflect the balance between supply and demand. By comparing the intensity of buying and selling pressure, it is often possible to ascertain the technical strength or weakness of the trend and the likelihood of determining the trend continuation or reversal. Buying and selling waves last as long as they have a following, just like momentum or anything else like that. Once the following is exhausted, the market enters a changing range or changes trend. These relationships often allow analysts to ascertain the behaviours of motivations of large operators, hedge funds, banks, and these operators are considered smart money. Just want to go back to that first paragraph. Wyckoff is a study of price, volume, and the relationship between individual waves of buying and selling. These relationships reflect the balance between supply and demand. That's a pretty good little summary. And if you want to read the original Wyckoff work, read the original Richard Wyckoff words, go to RTT Wyckoff WC manual introduction, the first item there, and just read through these pages here, and you'll see, I think the last page he says that you will thereafter think in waves. If you read those paragraphs in there, you'll understand why the site rttticker.com exists. Thanks for watching.